You need to start scaling back your risk 3 to 5 years out from retirement. Oh, wait. 10 to 15 years from retirement.
Hold on, which one is it?
This is a broad spectrum.
It is a pretty broad spectrum.
Right. And here we are. Let's unpack it. This is John Hicks, financial advisor, founder of J. Hagan Capital, host of The Retirement Solution, here to share with you insight on ways to better prepare for your financial future. I'm Heather Branch, here to ask John things that I see on the internet or hear from other people. I'm bringing it. I'm on behalf of you, dear YouTube watcher or podcast listener. I'm here for you. Hey, John, read this thing. What's up?
Yeah, no, it's interesting. So for years and years and years, we always heard 3 to 5 years before you get ready to retire. You just want to make sure that some major drawback, some major market blow, some major black swan event doesn't cause you to not be able to retire at the right time. So 3 to 5 years has historically been the standard. And lo and behold, all of a sudden, here comes a study. Was it Kiplinger that did this?
Kiplinger
did a study.
Yeah.
So Kiplinger did a study, and they say, okay, hold on, wait a minute. I know we've been talking about 3 to 5 years, but maybe we need to talk like 10 to 12 years out, right? And it's kind of like all of a sudden, but it did make me pause, and I did read the article, and I went through all the background information, and there is a case to be made. First of all, let's do this. Yeah. There is a case to be made for early risk reduction, especially if interest rates are as high as they've been. So I'm wondering if this piece is not going to be a little bit of period specific, because right now, at least the Fed just changed rates. But here recently, we've had really great interest rates. If we wanted to lock in some safe money and maybe get 5, 6, 7, even 8% with relative safety. And you can do that, of course, with money markets. You could have gotten close to 5, 6 or 7% on structured notes or principal protected notes. I saw some annuities out there not long ago that were paying 7 or 8 or 9% for income distributions for people. Those are rates that we have not seen ever, at least in my nearly 25 years in the industry. Those are crazy rates. So you could make a case and say, hey, if you pull back risk early, look at all these great things you can invest in. Those aren't that far off from long-term market returns. Now, having said that, I think it's really dangerous, especially when we look at inflation rates and what they've been doing, right? So the last administration, we had hyperbolic inflation. Why do we have that? Well, because of COVID, right? And that wasn't the last administration's fault, but we had COVID issues, and those caused everyone to clamp down. It caused all kinds of production nightmares, supply issues, demand issues, and that caused this whole system on the cogs to get all messed up, right? And then all of a sudden we have free flow of money going into the system, and it causes prices to skyrocket out of control. You put that on top of a free money situation where the Fed had interest rates basically at zero for so long, and hookah, you have crazy inflation. That's what we've had. So that's why in 2022, the Fed increased all of these interest rates. They increased them up to the highest that they've ever gone. I think it was the second fastest ever in the history of the country that interest rates went up that far, that fast. And what did that cause? Well, it caused inflation to slow down, which has been positive. But the markets have done nothing but gone up since then, which is really interesting. Okay, so what I think this Kiplinger article was trying to suggest is, listen, we may be entering a portion of the economy where the markets may not perform as well as we would love for them to do. Why? Because they've come up so far so fast. But because interest rates are still pretty good, maybe you can take some risk off the table and do okay. And I'm just very nervous about that. And a few reasons for that. But the main reason is because of inflation. Because what we're seeing right now, the Fed is not reducing interest rates because inflation is truly tamed. They're reducing interest rates because we have a job issue in the United States. We basically have a jobs recession already. One of the studies that I recently read talked about Stanford graduates with a better than B average unable to find initial positions out of college. Guys, think about that. If Stanford grads are having a hard time getting a job, there may be a bigger issue, right? So the things we have to understand is if we are going to have a jobs recession, and you couple that with the fact that artificial intelligence is keeping on and clipping on, and maybe we won't have some of these entry-level positions anymore, that makes me a little nervous. I think that we might need to not just descale risk. I think we need to reassess where our income streams are going to come from. Because Heather, I think it's one thing to say, oh, I think we need to de-risk. It's another thing is like, okay, if we go down to a lower risk environment, what are our expected returns, right? I think one of the things that we really need to consider right now is like, what are income streams that we can pay into at an earlier phase? Should we look at lake homes that we can make Airbnb money off of, right? Or Verbo or that kind of thing? Should we look at investment properties as secondary income sources, or looking at rental properties? When you look at the younger group of Americans, they really don't want to own, at least right now from large studies, they don't want to own their own homes. They'd rather rent. So could there be money in those type of environments? Maybe, if you like the idea of real estate. And I'm a huge proponent of real estate. If you look at the majority of self-made millionaires in America, most of them, many of them, were made that way because of real estate. So I think real estate is a great opportunity to consider. Now, is that really de-risking or scaling down risk? No, it's diversification of risk. It's making certain that amount that you're paying for that home, or even if you have a loan against it, right? I'm not against that. Leverage is how billionaires get to be billionaires instead of just millionaires. But if you look at that, I think that income stream could be great. So when we're looking at these things, de-risking, I'm a little curious about if that makes a lot of sense. 3 to 5 years is a pretty long period of time. But I think the real probably answer, Heather, really when you look at it, is gradual. Okay. How gradual do you want to, not just all of a sudden, hey, I'm going to retire in 3 years, now let's de-risk. The question is, at what phase should we really start looking at pulling some of those gains off the table and start looking in, maybe I should diversify for income reasons, not just for risk reasons?
Obviously, these are the kinds of questions that people want to ask you about. When do I start de-risking? If you're within 3 to 5 years, if you're with 10 to 15 years of retirement, at J. Hagan Capital, they can help you figure out some timeframes, because for everybody it's different. So visit us at retirementsolutionshow.com, or you can click on the links we got posted in the show notes. All right, let's talk about timeframes, because one of the things that we mention a lot, particularly on your radio program, is we always say, if you're within 5 to 10 years of retirement, give us a call.
Yes.
Thinking about risk and timeframes overall of our retirement plans, what do you recommend as far as timeframes go? Because I imagine, do you see it a lot where people will come to you, they're a year from retirement or they've just retired, and it's like, wow, I really wish you'd been here 3 or 5 or 10 years ago. We could really have done a lot more work.
Literally every single week, someone comes in and says, man, where were you 10 years ago? I was here.
I just didn't
have a big enough megaphone. Yeah, I was here. I just didn't have enough big enough megaphone, or you weren't necessarily, you weren't on the frequency we were talking about. My frequency seemed a little bit more stodgy, a little bit more holistic, and not really about growth, right? Because one of the things, Heather, that we fight with every day in our office is human psychology, right? The stock market has been on a tear. Nvidia is through the roof. Apple is making more profits than they have in a long period of time. Microsoft looks good. Google is got over this class action suit that they had with other things. Everything appears, at least the stuff that we hear about all the time, cryptocurrency, everything looks so good. And if we've had some money in that, we've made fortunes. And many of us are like, that psychology kicks in. It's like, man, but you know what? I've been getting while the getting's good. Why do I want to back out of here and either de-risk? That sounds horrible. Put my money in a money market. I make nothing. But my whole thing is like, maybe you don't de-risk. Maybe you just take some of that. Let's be honest, guys. There's a lot of luck. I know there's a lot of NVIDIA geniuses out there. I own quite a bit of NVIDIA because it's come up so much, but I'm not going to lie to you. I bought 20 other stocks at the same time. None of them did as well as NVIDIA. So I'm going to be very honest and say there's a good bit of luck that happens there. So,
and also, is everybody that's bragging about NVIDIA being as honest as you are, John, about it's like all this money I made off NVIDIA. Okay, what else did you buy in the meantime that you've lost on? A lot of people wouldn't be honest.
Because
like
I fight with my I fight with my own psychology every day. I'm just like, should I pare a little bit of that back? Should I just take a 5% reduction in that? Maybe, knock off and only the capital gains rate and then put it in something else. Should I maybe look at another condo to rent out or something like that? I think about this stuff all the time, and I fight it internally myself. So the real thing is that what I've discovered is that most times that we're having those internal demons and angels fighting, it's really just a lack of a game plan. So in my own portfolio, I do not manage my own investment portfolio. I've done this for 25 years. I have 3 master's degrees, mostly in finance and mathematics. And I do not manage my own money because my emotions ruin me. They've done it nearly every single time. From investing stuff for my kids to anything, I am not great at it. because my psychology gets in the way of the truth, which is, hey, you just destroyed that. You get 400% returns. Let's take at least 25 to 30% off the table. Now, here's the point. I don't think you have to de-risk it completely. Just diversify it. And what did I do? I bought real estate. And what did I do with that real estate? I made an income stream out of it. And in a few years, that real estate will be paid for. Hopefully, it's still producing a positive income for me that my family can utilize whenever we want to. And we're not able to use it, we can have that income from it. There's great gurus out there that talk about real estate investing all the time. I listen to them. They're really smart, but it's because they had a proper game plan. In our firm, what we want to do is we do not want to encourage only market investments. We want to encourage any investments that done correctly get you to the game plan in the end, which is hopefully to not have to work for someone else to be able to retire. That's really the whole point. And it's 5 things we have to do. We have to protect what we got. We got to create an income stream for it so we can retire. We want to make sure that we're being tax efficient and not giving all those gains to the government. We want to make sure that if anything happens to us, the people that we want to have the money get it, that wealth transfer. And we want to make sure that healthcare is covered, no matter if it's from Medicare or whatever else we do. We want to make sure that all those 5 things are done. So as we're going through a process for someone, de-risking is one thing, but the main thing is where does that fit on your overall plan? That's super important.
Having a plan. Ask yourself, do you have a plan that includes protection, income, tax plans for retirement with your withdrawal strategies, RMDs, all the other things you have to factor, also a wealth transfer and legacy plan, and of course that healthcare plan that John is always speaking about because of what he saw his own family, his mom and dad go through when they didn't have a healthcare plan and his dad tragically had a stroke. These are the things that have affected John and why at J. Hagan Capital, they do the kind of planning they do. Literally through his life experience. He's a small business owner. He is a proud Kentucky resident. He is a proud son, father, and husband. There's lots of elements. There's lots of relation that John has to you. So he understands your concerns. He has them too, and he's here to help you work through them. Visit us, retirementsolutionshow.com, if you've got questions for John. If you're wondering just a simple fact of when do I start de-risking or diversifying for my retirement, we're here to help you figure that time frame out. It's different for everybody, so it begins with your own customized plan, which you can start right now. Visit us at retirementsolutionshow.com to begin that conversation, or you can click on the links we've got posted in the show notes.